Hi everyone, and welcome to our Flagship Fund quarterly webinar. My name is Susie Collis and I'm the Head of Distribution for Caleb Brown Asset Management, and we're delighted to have you with us today. We have a jam-packed agenda for you for the next 40 minutes. We're going to be joined by our portfolio manager, Tommy Ragul, who is going to provide you with some portfolio insights, a current market overview, talk to you about the fund performance, of course, and provide you with a market outlook. And then we're fortunate to have our CEO, Jackson Zhang, with us, who's going to cover the major secular trends that are shaping the crypto industry today. Now, you'll see on the lovely webinar portal that we've set up that you can register your interest if you would like to have one of us reach out to you at any time. There is also a tool to enable you to chat with us whilst the webinar is in session, so please feel free to do so and we will monitor that, and anything we don't address at the time we'll get back to you with afterwards. There's also some handouts available for the webinar as well, so I'll remind you at the end of the session, but there's hopefully plenty to keep you entertained, interested and amused. Before we get stuck into the detail, just a note to say that what we're going to be talking about today is general information only. It doesn't constitute advice. It doesn't take into account your personal circumstances or objectives. So we recommend that you seek professional advice and that you refer to the information memorandum before making any investment decisions. The other thing to say, which I'm sure you've all heard many times before, is that past performance is not a reliable indicator of future performance, and we'll be talking about some past performance throughout the session as well. Okay, so before I hand over to Tommy, I thought it might be helpful just to provide you with some brief amount of detail about the funds to make sure that we're all on the same page in terms of what they are before we talk about the design of them. So, as you may be aware, our funds were launched and incepted in June of 2023, so they're coming up to 12 months of performance. And we have two funds available to Australian investors. Firstly, the Caleb Brown Flagship Fund, and then the Caleb Brown Flagship Fund Plus. Now, these funds are available to wholesale investors in Australia, and they've been designed for long-term capital growth. So we have a recommended investment timeframe of 5 years for investors. Doesn't mean that you're locked into 5 years, but that is our recommended investment timeframe. A couple of basic features of the funds are good to know. So they are designed and actively managed by a professional portfolio management team. And the idea of that is, of course, that gives you peace of mind that they're being taken care of by professionals and that you can sleep at night knowing that someone is monitoring what's happening in the portfolio. The portfolio is what we describe as a high conviction portfolio, but it does have some diversification. So we can have up to 25 different positions in the portfolio, and the number of positions we might have in that portfolio at any one time may vary. The portfolio has been designed again with a strong risk framework around it. So that's a transparent and rigorous process. And Tommy will talk to you about some of the tools that we engage in to make sure that that process is diligent and consistent. We are part of the Caleb Brown Group. As some of you may know, the Caleb Brown Group has been operating for over 7 years in the market and has a very strong heritage. So we're very proud to be part of that larger group of the company. We have an option for people who are interested in a derivatives overlay of people who would like to invest in the Caleb Brown Flagship Fund Plus. It's the same investment strategy as our flagship fund, but it does have that derivatives overlay for hedging purposes, so we can talk to you about that more offline after the session. In terms of investment amounts, minimum investment into these funds is $25,000 and for initial investment and for top-up, and you can invest in the name of an individual, in joint names, in the name of a company, in the name of a trust, or in the name of a super fund. So there's plenty of options depending on what suits your strategy. So that's some basic information. Now that we've covered some of that, let's have a look at the design element of the funds. And Tommy has a lot to cover today. So Tommy, maybe you can start by talking about what the operating principles of the fund are.
Sure, Susie. I'll first run through the investment philosophy of the fund, then I'll move on to the investment process. So the investment philosophy consists of 6 different tenets that underpin the way that we make decisions in the fund. The first one being risk control before all else. We view every investment opportunity through a risk management lens. which enable us to make sure that the rewards always outweigh the risks. Tenet 2, changes take time. We're patient investors. We invest in early stage technology, and usually the growth catalysts tend to flourish over the course of years and not days. The third tenet is high conviction investing. We focus on a smaller pool of investments, but we know them very well. Fourth tenet is that quality leads over time. So we believe that in the near term, investors may gravitate around those assets which are highly volatile, such as meme coins, but over the long term, capital flows to those tokens which are fundamentally backed, which lead to their appreciation, strong appreciation. The fifth tenet of our investment philosophy is themes catalyze adoption. At heart, we are thematic investors. We believe that structural growth themes provide this gravitational pull for adoption and growth. And our last tenet listed there is macroeconomic focus is not critical. Although our investment team are cognizant of the macroeconomic environment, we focus all our efforts on finding the most fundamentally, or the strongest fundamentally assets, irrespective of the macroeconomic environment. Now proceeding to an investment process slide. So you see a visualization of our investment process. It spans from idea generation to portfolio management. Essentially, it's the way that we identify assets, research them, pull them all together into a portfolio and dynamically manage them over time. So the first phase, idea generation, this is where we identify assets for research. These ideas might come from our own proprietary research, filtering, third-party research, podcasts, social media, and a variety of other sources. We tend to pull from a list of around 500 assets, and we use these assets now in the second stage of the process, where we conduct fundamental deep dive analysis and ultimately try to rate these assets to figure out exactly whether they qualify or not for fund inclusion. The third part of the process, portfolio construction, is where we pull together these assets that have been researched and we segment the portfolio in accordance with our risk and return objective. So we might spread the assets across different industry groups, different sectors, and size those positions in line with the conviction of myself and the investment team. The last part of the process is the dynamic management of our portfolios, so the day-to-day oversight and also the management of overall exposures over time.
Tommy, we've mentioned briefly that the fund is actively managed, and I know that you provide a written update to investors every month, which, by the way, everyone is available in the handouts that you can find on the portal. Can you talk a little bit about the current asset allocation of the fund?
Sure. So this slide shows a visual representation of our fund. Our fund strives to give investors exposure to a broad basket of assets in the crypto industry. We tend to balance, we're invested in around 5 sectors across 9 different industry groups. And we also try to strike a balance between infrastructure layer assets, which are on that top level there, and also application layer assets, which are on the bottom row there. The infrastructure protocols give a portfolio stability, whereas the application layer introduce different return exposures, albeit at different levels of risk. We tend to concentrate our alternate coin exposure within the DeFi sector in the bottom left there, and the reason for that is that we believe that it offers the most plentiful investment opportunities for our strategy to take advantage of. We tend to hold really little cash in the fund, only enough to pay for expenses in all growth phases of the crypto market cycle, but have the ability to raise 22% cash if we believe that we are about to proceed into a more precarious time in the market.
Tommy, what about the prevailing market conditions for the last quarter? What are the things that are notable that we should be aware of?
Sure, so this covers the market overview for the quarter ending 31st of March 2024. The chart shows a proxy for the crypto index, the CoinDesk for the crypto market, which is a CoinDesk market index in purple. And it also shows 2 US equity indices, the NASDAQ 100 and the S&P 500. As you can see, it was a really good time for risk assets. Stock market was still benefiting off that AI wave that really started going at the start of 2023. And also the crypto markets continued with that momentum that it struck about midway last year when BlackRock lodged for that spot Bitcoin ETF. So what we started the year with the general consensus in the market being that we were going to see 5 rate cuts by the US Fed this year. And so that really benefited risk assets over the quarter. But then what we saw in the third month of the year was that a hot US CPI figure came through, which rattled the market, which meant that some of those gains were paired at the midway point of March. Now, if I draw your attention to the key performance indicators on the right, the total crypto market cap rose 67%. This was an acceleration from the growth that we saw in the last quarter of 2024. It came within a whisker of meeting its all-time high that it struck 3 years ago. And at the end of 31st of March, it was valued at about 4 trillion Australian dollars, or circa 3 trillion US dollars. Really, the news story of the quarter was the launch of the Bitcoin spot ETFs. We saw a total of 18 billion Australian dollars flow into those ETFs, which really underpinned the move to an all-time high of around 112,000 Australian dollars, and also led to the expansion of Bitcoin dominance to a 3-year high of around 52%. We saw a contraction in Ethereum dominance. So the native asset of the Ethereum network, Ether, actually outperformed in January after speculation arose that a potential Ether ETF might be launched at some point. And then what we saw in March was a souring of sentiment when the market started to realize that this might not come to fruition for a number of different reasons. Stablecoin dominance also fell by about 30%. And the reason largely for that was risk assets rallied. Nonetheless, we saw a total of about 30 billion Australian dollars being added to the stablecoin market cap, which really shows that confidence is growing in the crypto market after that bear market that we had about 18 months ago. It's starting to recover, and this is starting to accelerate. So now I'll take you through some key takeouts of our investment team during the quarter. So the first one is that this crypto market cycle looks very different to the previous cycles. The first reason for that is market breadth is narrower. So there is a much more limited participation in the upswing amongst alternate coins. The chart that you see there on the left shows that in the year to the 31st of March, only around 15 assets in the top 100 have beaten Bitcoin on a price basis. There's a few reasons for that. In the eyes of institutional investors, after the spot Bitcoin ETF was launched, this asset was deemed de-risked by many. And so what it did was, in our eyes, drain liquidity from altcoins and to Bitcoin. Second of all, the market is in a state of maturation. So what we see now is, unlike in the past, when we do have these upswings, you don't see this broad-based participation like we did in the past. Another takeout here is that we saw speculation being brought forward. So typically, speculation among, say, the meme sector tends to flourish around the time of market crescendo events. But this time it got pushed forward, and the reason for that is that it's so easy to deploy a meme coin on high throughput chains such as Solana. So we've seen a lot more of that activity, and we expect that activity to be more pronounced throughout a crypto market cycle now. And the last point on the previous slide was that something that's atypical is that we saw Bitcoin reach an all-time high prior to the halving event. Normally we see Bitcoin reach an all-time high probably about 5 to 6 months after a halving event, and this was brought forward for the simple reason that the ETFs have somewhat distorted the traditional crypto market cycle, and we might have to see a more extended period of market consolidation to see it back in sync. Second key takeout is that we're starting to see innovation again in the market. Typically what we see from crypto market cycle to crypto market cycle is when the bear market comes around, innovation dies because developers get disenchanted by falling prices. So the flow-on effect from that is that venture capital tends to dry up. But then when prices rise, developers start building new crypto applications and the VC investors come back. And so what we saw in 2023 was that flywheel starting to take effect, And we've seen that momentum continue on in the first quarter of the year. We saw about $4 billion US dollars, circa 7 billion Australian dollars flow into crypto startups. This capital is flowing into a few sectors that are in vogue. The first one is Ethereum restaking, which effectively is where Ethereum stake is repurposed to underpin the security of other crypto networks, such as Oracle's, other layer ones, and so on and so forth. Another area of investment was the Bitcoin ecosystem. Innovation sort of has stagnated over the past 10 years in the Bitcoin ecosystem, and now it's started to ramp up off the back of capital that's going towards the development of layer 2 networks. So just like Ethereum is scaling via secondary networks, it looks like Bitcoin is going down that same path. And what this is doing is it's enabling Bitcoin to become a lot more expressive with the introduction of smart contracts and things that you're accustomed to in the Ethereum network. Lastly, we've also seen a lot of money being thrown at tokenization efforts. In particular, of note, BlackRock launched a $350 million cash on-chain fund during the quarter. And so we're continuing to see interest there snowball. The third point I have here is there's a growing emphasis on developing consumer-friendly products. So the killer use case in crypto right now are stablecoins. And we believe that for further adoption to occur, we need to go broader than this. How do we go broader? It's by making things a bit more simpler, right? Everything in crypto is quite complex and it's hindering the growth of the industry. So there's been this focus on making things more simpler, both on the software side and the hardware side. On the software side, a lot of crypto applications are now trying to integrate normal sign-on processes, such as your conventional username and password. They're introducing gasless transactions. They're truly trying to abstract away the complexities of crypto and make it more approachable by the layperson. On the hardware side, we're seeing things like custody hardware devices being integrated into mobile phones, such as what we've seen with Solana and their Saga phone. So there's a lot of opportunity in this space to bring on board the next billion users into crypto.
That's some great background information. It was an interesting quarter for the fund with perhaps a little bit of volatility. What can you tell us about the performance of the funds over the last quarter?
Sure. So this is a slide which covers the performance for the 3 months ending 31st of March 2024. The chart shows in navy that the flagship fund generated a return of 48.9% and the flagship fund plus generated a return of 47.2%. So what we saw in January was the market shoot up in advance of the spot Bitcoin ETF launches. Then when the launch came, the initial inflows were quite lukewarm. So the market started to pare back the gains that it added on from the start of the year. And so the first month, the fund was roughly flat. And then when Bitcoin ETF inflows started to accelerate in February, we participated in that upswing that the market had. And then when those hot US CPI figures came through in March and the market softened a little bit, you could see that the performance started to kink off, but was still positive, but started to kink off in March. So if I draw your attention to the right side of the page, we have a performance attribution here. So this compares our positioning effectively to the CoinDesk Market Index. So to start with the contributors first, what contributed to performance was being overweight the layer 1 industry group. So this encompasses assets that are like Ethereum, Ethereum and other smart contract platforms. So given that we have a tilt towards infrastructure, we benefited off this stance. The next way that we benefited during the month was being underweight layer 2 protocols. So a lot of layer 2 protocols in our eyes offer very little value accrual, have no utility, and have loads of supply overhang that will pressure those assets in the near future. So we stayed away from that industry group. The third industry group that contributed to performance was being overweight the derivatives sector. So over the quarter, daily spot volumes were up around 65%, and this rubbed off on on-chain trading venues. And given that we had an overweight stance to perpetual futures platforms, we greatly benefited off that during the quarter. Now, the detractors, the first being we're overweight credit platforms. So credit platforms encompass protocols which allow for the origination of peer-to-peer loans. And what we found was when Ether performance tailed off later in the quarter, those credit platforms that are affiliated with the Ethereum ecosystem started to tail off at a higher beta. So although there's no structural concerns with the assets that we have within this industry group in the fund, it was greatly affected by ETH's paring back of returns later in the quarter. Second of all, another detractor was being underweight transparent. Within this sector, Bitcoin is found, and given that we tilt towards alternate coins, this detracted from overall performance. Lastly, we were overweight the art industry group, perhaps misspecified here. The asset which contributed to this was a token that we hold at the intersection of crypto and gaming. And so gaming had a pretty sharp run up at the end of last year. So all we saw was some profit taking in the first quarter of the year, but we're not concerned with this positioning.
So thanks, Tommy. That's obviously a lot of insight and context around what's happened with the fund. What do you believe we should be expecting from the market over the current quarter?
Sure. Yeah, so we believe that we're going to approach, or already have approached a period of consolidation. So in our March performance report, we discussed how we thought the risks were to the downside. We saw Bitcoin hit a new all-time high. We saw Bitcoin have its longest run without a 20% pullback for around 10 years. And we also had a meme coin frenzy, right? So things were very heated. Typically what we see after a halving event is a period of consolidation of about 5 to 6 months. And this is underpinned by minor sell downs as they recalibrate their operations. And then what we tend to see is when the Bitcoin price goes up later in the year, they recover or break even on their revenues, and then the market starts to track up again. So we think we're going to track a similar path this cycle as well. In the chart which you see there, which shows spot Bitcoin ETF flows, you can see that in around March, we were seeing net inflows of about $1 billion US, and that's been pared back so to about flat at the end of April. So we're definitely approaching, or have approached, that consolidation point, and we propose that we're going to see a bit of chop over the next 5 to 6 months. Another point is that we believe that we're going to see a recalibration of market focus to real utility and economic value. In the first quarter of the year, the focus is really on Bitcoin and meme coins. So we believe that the rise in Bitcoin created somewhat of a wealth effect, which rubbed off on the altcoin space, particularly amongst meme coins. But our thesis is that now that Bitcoin's been introduced to institutional investors, when they start to look down the risk spectrum, they'll be attracted to those assets which are fundamentally backed, have true utility and value accrual properties. And so I think the focus will switch from the more speculative elements of the market to assets which look and feel like the assets which they invest in day to day. So we believe that airdrops are also going to underpin the next innings of the crypto market cycle. So for you who don't know what airdrops are a distribution of a project's token to incentivize early use of the protocol itself. So in 2023, we saw around $4.5 billion in airdrops being granted to early adopters of protocols. Although that was down from about $8.5 billion the year before, in absolute terms, it was still a sizable amount of capital. We believe, given the increase in the proposed increase in token generation events this year, we believe that we will eclipse this number from last year. And so what this is going to mean is we're going to see several capital injections with retail investors effectively becoming recapitalized, and we believe this will underpin the next leg of the crypto market cycle. Now I'll pass you over to Jackson to go through some of the structural growth themes in the crypto market.
Thanks, Tommy. So, because it's our first webinar, we'll zoom out a little and look at the long-term secular trends that are going to really be driving growth in the cryptocurrency industry. This is also why we built an asset management business to begin with, because we think this space is highly investable. So the first trend we're going to talk about is the demographic tailwind. This chart here on the screen is a 5 million sample of JP Morgan Chase accounts, and it breaks down the interaction with crypto exchanges by generations. So you can see here the blue bars represent males. So millennials have a crypto adoption rate of about 26% this is mid 2022, and then Gen X at 14% with boomers at 5%. So the takeaway here is we remain a largely millennial asset class, with millennials being 5 times more likely to be allocating to the crypto industry than baby boomers would be. This next chart here is wealth distribution by generation in the US. And what we can see is the category that remains largely unpenetrated for crypto, which is baby boomers and older, hold collectively 65% of US wealth, with millennials, the main allocators to crypto, holding only 9%. So what this means is over the next 15 years, as Gen X and millennials take a greater share of US wealth, we believe that we'll be observing a tailwind of further asset allocation into the crypto industry without, this is before accounting for any further user adoption in the asset class. To begin discussing our second secular trend, here's a chart of Bitcoin's year-on-year growth compared to M2 year-on-year growth globally. M2 is a measure of money supply, and so what we're seeing here is a high correlation. So that is to say that when rates are low and money supply is expanding, that's great for Bitcoin. When rates are high, money supply is contracting, that is typically bad for Bitcoin's price performance. So what this ultimately says is Bitcoin performs as a risk-on asset. However, we're currently in a high-rate environment, and relatively speaking, both crypto and the Bitcoin and crypto are performing relatively well. So, why are we observing this? And that's because of a secular trend, which we call the second secular trend. This is that the sovereign debt bubble is accelerating the rate of currency debasement, and ultimately that benefits Bitcoin. So how does this work? On this chart, we are seeing the growth of federal debt over the last 50 years. And it shows the rate of acceleration from less than $1 trillion of federal debt to over $33 trillion today. And what that means also is that we have grown from about a 35% debt to GDP ratio to 120% debt to GDP ratio. And why does this matter? Well, it matters because when the central bank raises interest rates from nearly 0% to 4 to 5%, what that does is it adds $1 trillion of interest expense to the government deficit. And the government deficit is someone else's income, which means it actually has a stimulatory effect on the economy, which is the exact inverse of what the central bank is trying to accomplish, right? Because central banks, with their monetary policy tools, typically they lower the interest rate to have a stimulatory effect on the economy, and they raise interest rates to have a tightening or cooling effect on the economy. And when we've ballooned the federal debt to over 100% debt to GDP ratio, such as today, what actually happens when we're raising interest rates is that it compresses the expansion of money supply in the private sector through commercial lending, but it actually increases the inflation effect on the public spending side. So gradually, as the federal debt grows, the central bank's ability to tighten or cool the economy also weakens. And ultimately, that means that it's harder for the central bank to have control on risk assets. leading to greater adoption in Bitcoin. This next chart here demonstrates the effect of what we described previously. So this here is the risk to return ratio of various asset classes with Bitcoin all the way to the top right. So what does it say? Well, obviously Bitcoin is a very high risk asset, but it's also very high return. But what I want to draw your attention to is the orange dotted line, the curved line at the bottom of the chart. That is the efficient frontier. And what the efficient frontier is the along each unit of risk, that is the most optimal portfolio that you can construct with those constituent components of a portfolio to build the best unit of return per unit of risk that you're happy to hold in that portfolio. And we can observe that Bitcoin sits well and truly above that efficient frontier, which is a significant driver to the recent adoption of Bitcoin amongst ETFs by all the largest asset managers in the world. Our final secular trend is very simple. This is a chart of the S-curve adoption rates of various technological innovations. So crypto is a network, and a network's value is the product of its nodes or participants, which means every incremental user that adopts into the crypto network also increases the value of the network and also makes it easier for the next incremental user to adopt. And therefore, the growth rate is expected to accelerate each time and face an exponential growth curve. So as a network, we believe crypto will also exhibit those exponential growth properties, adding to our third tailwind for the crypto industry. And I'll hand back to Susie.
Thanks, Jackson. There you go, everybody. Some really informative topics today. Hopefully you enjoyed that. We're at the end of our session, so please don't forget to fill in the Contact Us form. We'd love to hear from you, and if you'd like some more information, we'd be delighted to provide it to you. You can follow us on socials, so Twitter and LinkedIn. There is a Caleb Brown Asset Management LinkedIn profile, so please join us there. And thank you again for joining us today and for your attention. We will have this presentation available for you in the next week if you'd also like a copy of it. And don't forget the handout, so please download those if you'd like to read some more. Thank you again.